Morning, ladies and gentlemen. I'm Richard Redmayne and help to run SP Angel. Coming across? Hear me? Yep. Yeah, good. And I've got a very distinguished panel here who are going to tell you how our industry is going to go forward the rest of this year and 2018. We've got 3 bits of money, very good analyst, and a commentator. Quite an interesting commentator, anyway. Going from the left, what have we got? A very good analyst. It's Colin Smith from Panmures. Colin is learning Russian at the moment, so that may have some interesting bearing on what we're going to talk about. Gervais and I go back a very long way. He is a champion of the small to mid-cap oil company, and has been so for a very long time. And if you look at his track record of investment, he's been a hero there. So, Gervais, welcome. Nick Stanbury I hadn't met before, but I know a lot of his colleagues in Legal and General. He's basically the more money than God quoted investor. So we'll see what he has to say about a few things. And finally, we've got Peter Petrov. Now, Peter, First Reserve is, I think, probably one of the largest dedicated hydrocarbon private equity investors, principally private equity, although a little public. And alongside Legal and General is probably also more money than God. Finally, Malcolm Graham Wood. Malcolm, you're a commentator. You're a very positive, you are, yes, very positive commentator. So we're going to have a lot of fun when he has something to talk about. The way I'd like to run this is from the way the first presentation went. It sounds as though we've got an audience who actually will ask a few questions. If you remain silent, I will have a few to get my boys going. But shall we sort of open proceedings by at least having a question from the floor? Right, you're all silent. How about, Colin, some aspects of what we do bear on the battle between the Russians and the Saudis fighting the US shale players. Thoughts on that, particularly as a Russian speaker?
Well, clearly we've seen some very interesting developments since 2014 when Saudi Arabia basically stepped away from price support. Obviously it's been characterized as a battle against shale, and we can argue about that, but in any event it certainly had a pretty significant impact on investment going into shale. But the pain was enough to bring OPEC back to the table. So we've had now getting on for a year of OPEC generally being fairly successful, I would argue, in terms of supporting the price. I'm not sure 60 is the right number, but effectively I think actually between Saudi Arabia, Russia and the rest of, and the shale in the US, the question is what is the number that stops the market from being overwhelmed, which at the moment I think really boils down to how well can shale producers do. And I think if we look at what's actually been happening, we find at $50 oil, actually some of the major shale formations struggle pretty hard, Eagle Ford and Bakken in particular. So the real growth is coming from the Permian, and we're finding out just how much can be done out of the Permian. But those of you who follow operating statistics and so forth will know that actually the rig count's been falling for a while. US production is still going up, but I think there's much more of a question in the second half of the year about just how untrammeled the pace of that increase is likely to be. Nevertheless, quite a lot has already been built in, and that, despite OPEC's strong compliance with its cuts, because Libya and Nigeria were outside of the cut process, actual OPEC production has been going up over the last few months, so next year actually looks pretty balanced. I think with respect to Russia and Saudi Arabia, what's very interesting actually is, from one perspective, the agreement for non-OPEC and OPEC to work together actually involves Russia becoming more like a member of OPEC. And that is a really interesting development, and I don't think it's really one that's commentated on particularly in that fashion. So if anything, at the moment, there's almost more cooperation now between Russia and OPEC than there has been possibly ever. And I think that partly goes hand in hand with the fact that Russian production, at least oil production, has sort of hit, I wouldn't call it necessarily a peak level, but it's not a level that's increasing particularly at the moment. And I think the whole stance of the Russian government is to try and maintain oil production roughly where it is. And also from that perspective, it's therefore much more interested in price support than it used to be in the past. So a battle between Russia and Saudi Arabia, if anything, it's actually a bit more cooperative. And we're all waiting to see what America can actually do if the oil price holds at, say, 55 to 60-ish for oil. And the one thing I'd also add, as you will also know, the spread between WTI and Brent has opened out pretty significantly, which means that US producers aren't seeing the rise in global oil prices in the way that we think of Brent having increased.
Brilliant. Okay. Far away. Have we got a spare microphone here?
I can shout, actually.
Can you? Shout.
Yeah.
Right.
What's your view of the current investment in the US in shale? Is it growing? Is it diminishing? What's happening there? Because I hear different stories about whether it's going up or down. Do you have a view about that?
Actually, it's not obvious quite what it's doing at the moment. I mean, investment has gone up this year as oil prices have come up, but how far it will carry on is much harder to say, not least because if you have a look at financing for shale companies in the US, there's been very little equity support from them, so there's still plenty of debt going into them, but I think equity providers have been burnt pretty hard by their experiences over the last couple of years, so there's less enthusiasm to provide equity to them, and that is actually likely to be a bit of a constraint. Although, at the end of the day, the vast majority of the world's capital goes into North America. I mean, it's 80 or 90% of global upstream spend goes into North America.
Thank you. Right. Any more questions from the floor? Or you're still in your silent mode? Right. We're being threatened, perhaps, some markets, not sure, either the US or here, but maybe nowhere, with a certain 5% of a company called Aramco to be for sale. The question I'd like to ask, actually I'd like to ask Nick, as a major quoted equity investor, why would anyone want to buy shares in a 5% float of Aramco?
It's something like an easy question to get you going, isn't there? So there's an awful lot of reasons to be very apprehensive about Saudi Aramco IPO, but there is a price for everything. But I suspect that the right price to get me personally interested in buying Saudi Aramco shares would have to be really a very low one indeed. The one thing that would have been very interesting about Saudi Aramco, had it decided to IPO, I think would have been the disclosure that they would have been forced into as a company from an operating statistics perspective. They'd have had to provide an awful lot of history and historic financial information that would have been quite interesting. So in some senses, I'm a little bit sad that it looks like, reading the tea leaves, that they're not going down that route. But maybe they're going to change their mind again, who knows. But getting access to some of the information that would have come with an IPO would have been quite interesting.
You would have enjoyed the information,
Exactly.
but probably not bought the stock. Okay, that's fine. Any thoughts on that? Have I got any investors out here itching to buy their shares in Aramco? Complete silence. That's quite interesting. Thank you. Right. Peter, we have sort of cycles. We have cycles that sometimes my investors here go crazy and they award valuations to quoted equities, or even private ones for that matter, way beyond what the professionals consider to be real value. And so you, the great investors, however many of you here, get stuffed by people selling very expensive investments. And then it goes the other way, and you get to somewhere like February 2016, the most recent one, I suppose, $27 oil, end of the world. The cheapest way to acquire hydrocarbon assets was to go and buy a quoted company. And they were all for sale, they were all going bust, and they were very cheap indeed. And Peter, what are your views? You are a major player in the unquoted world, but where does the value lie right now?
Would love to answer that, but before that, I'll give the chance to the gentleman there to ask his question, because...
The question I have with regards to Aramco, one float off 5%. Is that a function, do you think, that some consultants told them that... Excuse me. The question with regards to Aramco, do you think that some consultant has told them that they've shown that graph of EV penetration and the fall in price of oil, and so they've decided, well, we better flog off 5% or something of the company because a lot of this oil might be left in the ground and we'll be back riding camels again?
So that's a good... I don't know, do you want me to answer that? Or?
Yeah, far away.
My suspicion is that they're probably in possession of enough information to know what the real scale of the threat to oil demand that EVs pose over what time horizon. And therefore, I suspect that it's not motivated by a fear of an existential threat to their business overnight. And my personal view on the threat that EVs pose to oil demand is that it's pretty moderate for quite a long time. Just because of the simple mathematics of it. And do they have a 50-year time horizon? Are they worried about oil demand on a 50-year view? Yeah, no doubt. But there are lots of reasons to think that there are advantages to bringing a company of that sort of size to public markets. In theory, if you IPO a really large state-run company, you get all the benefits, supposed benefits of the transparency and the continual challenge of all these clever people like me who kind of continually question the operating decision you're taking. But it would never have worked like that with Saudi Aramco. So I can't believe there would have ever been any benefits of that sort. So I suspect it was a question around arbitraging your own knowledge of what your future tax rates are likely to be versus the future tax rate that was implied in the price of Saudi Aramco when it was IPO'd, if I'm deeply cynical, is what their real motivating factor probably is.
You know, I think I've got a slightly different view, actually. I think anyone who buys into a minority stake in a company does so at their peril. And we've seen numerous examples over the last 5 or 10 years, particularly I think one or two of the sort of Russian issues and mining issues where you haven't got a chance. If you're a player in a 5 or 10 or 15% holding in a company, and the remainder, the other, that's the maximum free float, and the remaining 85%, you are toast. Time and again it happens.
I think you're missing the point, Richard.
Oh, yeah?
Yeah.
Okay.
But I'll go after Peter.
Well, feel free, because it's on the same topic. So
I've got a feeling, and I'm not here to argue with anyone, least of all Legal and General or Richard Redmayne, but I have a suspicion that the Aramco flotation was never about getting a presentation in the Legal and General offices or anybody else's offices for that matter in London or probably anywhere else. I have a view that they wanted to just go out and test the water a bit, get a little idea of what's going on in the marketplaces, and then sell 1% or 2% to the Chinese and 1% or 2%, and then possibly a little bit of it up, and give a bit of an interest in Saudi Arabia for people, countries possibly who would want a stake in that business. I don't think they were ever. I mean, they might have gone to your Fidelity or whatever, but I just don't think that was ever the plan.
There's a view.
yeah, maybe just 2 cents on that myself, because everyone clearly is interested in it. My view is kind of slightly in between on Aramco. I think they just need the money, and that's the main reason why they want to sell it. Otherwise, I don't think they would ever think about it, because of all the disclosure requirements, and if they list in New York or London, SEC and FSA all of a sudden have regulatory power over, the Saudi state. So there's a lot of political implications. So they really need the money, given what the Crown Prince is trying to do with Saudi Arabia and really transform the economy, transform the country. They need a lot of money for that. And so I think that's the reason. I do tend to agree with Malcolm, because on the point that I agree the Saudis never really thought about doing this kind of the way a Shell or BP would go about it. I think this is going to be a much more tailor-made process where the big sovereign wealth funds are going to play. And the reason for that is the reason why Nick was saying that, look, there's a lot of question marks around disclosures, around ability to enforce legally, etc. So it's just not conducive to the big wealth managers. But I really think they need the money, and because of that, they're going to raise money one way or another.
There you have.
Do you have a view, following on from that, as to the closure of PetroSaudi?
Honestly, not really. Not really. I don't have a view. I don't know if the other panelists do, but yeah.
Any views? No. Thanks. Hang on. Yes, of course. Don't mind.
How does the panel see the integrated oil companies sales and working out in 10 years' time between alternative energy, conventional energy, upstream and downstream? Do you see them all diversifying into solar and alternative energies in order to save their future? And in that regard, who do you think is best placed to take advantage of the revolution that we are clearly seeing at the moment in terms of the energy market?
Gervais, a thought?
I'll answer that one. It's amazing the valuations which are being put on EV, new energy, all the rest of it, compared with that of existing production. I think that extreme is far too wide, in my own view. I think that EV will form part of the future. Some of the newer windmills and other things will form part of the future. But my view is actually that they form a much smaller part of the future than the valuations are already saying at the moment. I think actually investors are much better actually skewing back and looking at existing production, immature production, production generating cash on a short-term basis. I think the opportunities for investors at the moment are very much to actually look at the overall oil and energy supply, which is the cornerstone of all economy. Economic growth has picked up in the last 12 months particularly. There's a real assumption that perhaps economic growth will go on from here. But generally, the ability to supply energy between now and 10 years' time or 15 years' time, I think is going to be a big shortage. Most particularly, many of the majors have cut back on investment plans. We've all heard about that. Many of them are assuming that even if the oil price goes up to $60 or $70, it doesn't do so very long. So for that reason, they're not willing to push those 5 or 10-year cash payback plans. And so I think there could be a shortage of energy, say as soon as 2019. So I think there's a great opportunity to actually for investors to just circle back and look at real assets in the ground, assets which are close to production, assets already in production, big and small companies, and actually I think that would be the most attractive area of investment. In fact, I fear that if we find that economic growth continues at a faster rate perhaps than recently, we'll find that actually there's a shortage of energy for world economy by 2019, and that itself may lead to a world setback in terms of a world recession on the basis that there's not enough energy supply and the cost of energy gets so high that it actually cuts off the growth of the world's economy.
Interesting.
Richard, keep.
Oh, sorry.
No,
There's a slightly separate question. So, what would you do as an investor today in terms of? I mean, I agree completely with all those comments, but if you step back for a second, you think about a company like ours, which has huge holdings on the passive side. What should we be encouraging those companies to do where we have no choice over whether or not we own them from an index fund management perspective? And I'm not convinced that BP or Shell or anybody else has a really, really strong competitive advantage in the renewables business relative to anybody else. That doesn't necessarily mean that there's a reasonable case for being part of that industry, but does it necessarily follow that the right thing for those companies to do is cut the dividend to zero and allocate 100% of that free cash flow as and when it comes to in making massive investments in solar farms and wind farms. I'm not sure that that necessarily follows logically, which I think was the question you were asking.
I'll give you an idea of why you should think twice about the common sense and intelligence on the boards of some of these companies, is because what happened in when the oil price started to fall was that they immediately, because they had overcommitted themselves on dividends and therefore the balance sheet was stretched, first thing they had to do was to take away money from their short, medium and sometimes long-term capex plans. And I started writing about this, and all of a sudden, and Woodmac and I were roughly doing the same sort of numbers, but we got to the stage where quite quickly we got 500 million off capex, and before long that became $1 trillion and then $2 trillion. And these are all projects which were meant to come into production in 2021, 22, 23 because of the nature, things like Mad Dog and everything else. This is where I totally agree with Joe's, is because what we're going to have a situation where, because the majors did take away all their capex, they're going to have the oil price up and they're going to need to invest in renewables, so they're going to have to chase after renewables. The answer to your question is Exxon.
There you are.
Right, you asked which was the best placed, which was the company that was putting the most down in the right places from the majors, and I think it's Exxon.
Okay. Far away, sir.
What's your view about some of the disparity in valuations on... Thank you. Could you just explain your view on the disparity on the valuations of a lot of the renewable companies? Having seen quite a few of their cash flow projections, they survive on IRRs of 10, 11, 12% if they're doing well, and sometimes below that. And how can they be seen as better investment vehicles than hydrocarbon projects where the IRRs are in the 20s and 30s? What's driving this misconception that they're a better investment vehicle?
Well, it's political acceptability, partly.
Well, certainly, I mean, I think what's interesting about the market generally, and that's not just in the renewables, but actually in terms of the US market, which is actually not being led up by the S&P index, or indeed the Dow index. The index which is outperforming by an absolute mile in the US is, of course, the NASDAQ market. And that's including an awful lot of growth companies. And these companies, some of the renewables, are seen as growth. So growth, the price of growth is just sky high at the moment. So we saw what happened to Amazon on Friday. They reported a little further growth than expected, and the share price rose by about 10 or 11% in a single day, adding 150 billion or whatever it was to the value of their company. So we've got a real momentum-driven market. Share prices are driven by momentum. Fund managers are naturally commercial, and in their commercial judgment, some of them are feeling that they're not able to retain their clients by having an underweight position relative to Amazon or indeed any of the other sort of new wave technology stocks. And that's leading to investors narrowing their interest in just a number of companies. We do have something similar in the UK, of course, with the AIM market, which is leading the UK market at the moment, in spite of worries about the election result, perhaps, or Brexit coming up. When you look at the UK market, it's not being led by the FTSE 100 or even the FTSE 250. It's been very much led by the AIM market. And a very small number of very high growth stocks at the top of the AIM market are driving the same feature. So this is a momentum feature. It's a momentum which carries on until it stops. I can't say whether it's going to stop in the next 3 months or the next 3 years, but boy, it is going to stop, and there will be some tears.
So you think it's a bubble too?
I mean, yes, in a word, yes.
The only other thing to consider, I mean, I'm broadly sympathetic to that viewpoint, but the total capital required by the renewable industry under IEA forecasts, I think is $50 trillion over the next 50 years. Which I think is 5 times the total capital employed by the entire energy industry today, by the entire quoted energy industry today. So I think the logical corollary of that is that there's questions around valuation and relative valuation between growth and value, and I have a lot of sympathy with those points. But it's very difficult to argue with the fact that there is going to be tremendous regulatory and policy support for renewables for a very long time, which probably does mean that we need to think about very different costs of capital between the two industries. Because the there's only one place that money can come from, which is from global capital markets, and that means that the renewable industry is going to enjoy tremendous policy-driven support and will enjoy a significant cost of capital advantage as a consequence, I think. I don't think that can explain all of the valuation disparity, but it is that there are always two sides to the coin, and I think that is part of the other side of the coin.
Thought on that, Martin?
Yes, I mean, my thought is that I did hear John's speech, and I can understand about EVs and about even with some little trucks doing their work around some parts of the US, for example, with LPG and LNG and everything else that he mentioned. Americans drive 2 trillion miles every month. The average age of a car in the States is 17 years old. I rest my case.
Okay. Right, one more. Hang on, no, right at the back.
Is there something in the social and sort of inness of being an investor in renewables, such that perhaps some pension funds are gravitating to that, such that it's acceptable, as it were? And in a sense, if there's new funds created in that space, they have to find a home for the money. Is that a contributor to the short-term bubble?
Far away.
I can try to tackle that a little bit. I think we just saw an announcement, I think from the Oxford Endowment a couple of weeks ago, how they're no longer, or maybe they're considering no longer investing in hydrocarbons. There's a couple other big funds in the world that have said that, but I doubt that's going to be a material contributor. There will be some, but as Nick just said, I mean, we're talking about trillions of dollars. So a couple of billions really not going to move the needle on that one. But if you allow me, Richard, I think the other thing that the panel, we haven't discussed so far, and I think it's very important, and it fits into all of the topics around traditional hydrocarbons versus renewables, you know, cost of capital, cost of return of capital. I think technology is going to play a key role into this, in my opinion. And I think going back to the gentleman's question around the majors and the super majors, I'm not sure if you know, them becoming a renewable players is going to save them. But I think one thing will definitely cause them issues if you take more of like a 10-year view is not embracing technology. And I think they're onto that, and I think all the big companies are creating these big VC internal funds that are pouring, you know, hundreds of millions and billions into technology. Because even in the U.S., for example, you know, Permian clearly, you can make money at $30 oil. You can't do that anywhere else. But if you really embrace technology, and if the technological innovation continues, I think even in the Bakken and in the Eagle Ford and some of the higher cost basins, you're going to be able to start making money at lower oil prices, which will have a pretty big effect on the global oil price. But I think in general, the oil and gas industry in particular has been the slowest adopter of technology out of any other major industry in the world over the past 100 years or so. So I think that's going to have a seismic shift on how we think about all the topics that we're discussing here, at least just my views on that.
So just on Saudi Aramco. So China has a huge requirement for oil over the next 10 to 20 years. Could this not be some leverage from China to be able to get into some sort of agreement to then use CNY for, you know, the slow demise of the petrodollar?
I'm quite sure that's right. Quite sure that's right.
So that has huge implications then for the US.
I've had a lot of sentiment about the $50 and $60 price. Going back just to March this year, we had 55. A couple of months after that, had people talking to me about 35 again. So what are your impressions about downside aspects? Nothing you have told us today really indicates anything other than a 45 to $55, $60 range as far as you guys can see. Is there anything that could disrupt that kind of set?
I'm happy to give a start to that answer. The first thing, which is relevant... Yeah. I won't spend long on it. But
Well, it's,
I mean, I think the thing which we haven't touched upon, which is actually very important, is that world productivity growth, which is growing quite nicely prior to 2006, has flatlined around the world, not just in the oil industry, but right the way across all industry sectors since 2006. And that generally means that productivity isn't generating more cash for paying wages growth. It's not paying much cash for dividend growth. Dividend covers come down a long way. And of course, it's not funding ongoing capex in the way that we had previously. So I think that is going to lead to subnormal world growth going forward. We might have growth picking up right now. It looks as though people are upbeat at the moment. I don't think it'll last. I think we'll in a long period of subnormal world growth. And if that is the case, then of course energy demand may be growing a lot less rapidly than most people think. So you could get a setback in world growth next year, perhaps for whatever reason, perhaps geopolitical reasons or something, and you could see that oil price could spike down again. So I'm not saying it won't go down to 35 again. But what I do think is that the seeds are set now where we have an energy shortage, even with subnormal growth. So that over 2019 and there beyond, I think oil prices will be higher than most people think and sustainably higher than most people think.
I think with respect to current prices, I think if you look at the supply-demand balances for next year, the market actually looks pretty balanced, which means the tightening that we've seen this year probably comes to an end, actually, towards the end of this year or the beginning of next. And I think oil struggles to stay high, as in push through 60, certainly, under those circumstances. I think the tension you've got at the moment is what can the US actually do? And as I mentioned earlier, I think the jury's a bit out on that. I think the bullishness has come back a little bit. And on the other side of it is what is going on within OPEC itself in terms of the kind of volumes that are coming out of them. And right now, I think the thing that's actually driving the price is just the uncertainty on what is a fairly tightly balanced market. The marginal moves make a big difference. So I think right now the issue is with the problems that we've actually got in Iraq at the moment. I mean, have we lost 300,000 barrels a day out of Iraq? If we have on a fairly reliable basis, that's actually quite a big deal in terms of pushing oil up to a $60 type level rather than having it languishing around the mid-50s or something like that. But I do feel, and I'm not quite so pessimistic, I think, about energy being as tight, perhaps, but I can certainly see the risks of it. But I think we are sort of in a world where 50 plus feels like it's the right sort of number, and I would come back to the point I made at the very beginning. OPEC is clearly interested in price support again, which it was not. I mean, we had 2 years when OPEC was not engaged. It is engaged now.
So I'm not going to make a precise forecast because the only thing I know about trying to forecast the oil price is with great certainty that I'll be wrong. But there's a few things I think are changing, which I'm not sure people are fully appreciating. The first is I think there is a very, very big capital market-led change in the behavior of US oil companies. And by that I mean I think the patience of US capital markets to continue to finance cash-negative businesses to grow at 30% a year whilst consuming a unknown quantity of high-quality inventory is running out. So that's the first thing. The second thing is I'm not convinced that that there are many US plays which really earn their cost of capital at anything like a $30 or $40 oil price. And the third thing is I don't think anybody knows with any certainty whatsoever what happens to the economics of a shale oil business when they slow down. So there's definitely something that changes in your operating costs as a mid-tier shale play when you slow down your rate of growth. And I can't prove it for sure, but I think they go up really quite a lot. And I think they're going to start running into all sorts of interesting problems. And I think we've not seen that in the data because they've been growing so fast. And when you're growing very quickly and adding incrementally higher graded wells to your production profile, that flatters your cost structure a lot. I think that the data point that I wish US oil companies quoted to us, that I think they never will do, is something like the gold industry's all-in sustaining cost number from an OPEX perspective. Because those OPEX per barrel numbers rise an awful lot. And it's one of the things I think that will tell the gas and the oil industry in the US apart. And I'm not sure people are really on top of that yet, because I'm not sure that we can be on top of that, because I don't think they really tell us the whole truth about their business models. So if there comes out to be a big disappointment from US shale, particularly the Permian guys, about how fast they can grow and what the real economics of their business are, then I do think we have to start asking some real questions about, can the world survive on a $50 nominal WTI price forever? And I'm not sure it can, but this is slightly weaselly evasion.
Yeah, look, I actually agree with a lot of what the panelists said. I think in the short term, the answer is who the heck knows. Right, it's a very volatile industry, and there's a lot of momentum trades, etc. I think if you take a more of an intermediate or long-term approach, I agree that there is a lot of support at kind of the $50. In the U.S., outside of the Permian, I think people don't make a lot of money below $50. So, and that is with technological innovations, et cetera, where the U.S., I think, is a champion of that. And as we know, outside of Middle East and maybe Russia, there's very few places around the world that make a lot of money at $50. So I think fundamentally, I mean, again, who knows, right? I definitely don't know where oil prices are going, but fundamentally, you know, over a 5-year period, there should be some support, pretty strong support at kind of the 40 to 50. Is it going to go up to 100? Again, I think there are scenarios where it could very well happen, but they're more kind of politically infused, and it's not really fundamentally driven. So if you look at the fundamentals, my personal view is that you would see a range bound between $50 and maybe $70 oil in the next, I don't know, 5 to 10 years, but maybe there's major spikes on the way, which are impossible to predict.
And we've got, yes, a nice range now. I mean, the interesting thing, I mean, I'll come back to shale in a second, but it was ironic that my year-end forecast of $60 for this year, halfway through the year, I was really getting worried about it and thinking, you know, we're never going to get close to it. Now, last Friday, we could have shut the book on that when it closed over 60 on Friday evening. But the one thing I've been saying a lot is for some time is that I wouldn't be worried about US shale ruining the party, to be honest, because I genuinely agree with almost everybody that's spoken in the last few minutes, is that I don't think there is very much of it which is profitable, and therefore, when it gets over $50, they'll probably come in and bring out a few proven and undeveloped or whatever it was that they had ready to go. Quite a lot of that is done already, and quite a lot of it is already showing quite a big fall in production. So actually, although we're talking 10 million barrels a day, you have to bear in mind that the demand is creeping up to the magic 100 million barrels a day. So percentage-wise, for the extra bit that we're going to get from that, I'm not too concerned.
Yeah, I mean, we heard from John how the majors have about 3/4 of the world energy supply future. But of course, the whole point about smallness is it's not just about scale. The whole point about a small company is a small amount of difference makes a big difference to the share price, makes a big difference to cash flow. Companies are small and agile, can move in. They have lower costs than some of the majors. They're more agile than some of the majors. And in doing so, they can take advantage of changes in the market. And boy, have there been a few changes in the market over the last 5 years. So whilst you know, some of the smaller companies, particularly some of the smaller quoted companies, may feel a bit overlooked, may feel a bit unhappy about their share prices. Cost of capital is very high at the moment. I certainly recognise that. I think there's going to be a great opportunity for you to put some capital to work. I think as we get into a period where perhaps the long-term future of supply is more uncertain, I was very interested by what John said about the oil price since 1980 has been driven by the price, but now it's going to be driven more by the volume. I think volume is going to be a really key issue. I think there'll be a lot of big assets, which may be very good, but perhaps are unviable. You know, we think about the Canadian tar sands and some of those areas. I'm actually much more cautious than most others on shale, US shale. I noticed that US shale this year has lagged IEA forecasts or estimates by up to half so far in 2017, despite the fact the oil price has been coming up quite sharply more recently. And so I think there's going to be more capital to work at the bottom end of the market in small and micro-cap areas. Many of the small value plays are vastly overlooked at the market, as opposed to the high-growth, large-cap plays, which are sort of the sexy area at the moment. And I think that will be rebalanced over the next 3 and 6 months.
Thank you. Sorry. Right. I've got a machine here which sort of is ticking away. What do you think that is?
I think it tells you you've got 1.5 minutes left.
1 minute and 28 seconds. Next,
There's a question there.
Sir.
Can I ask the panel, so the US shale players seem to be... So the US shale players seem to be getting rewarded by the market for an economic model that doesn't necessarily make a lot of sense. What's your message to the junior explorers in the rest of the world, and what sort of economic model should we be presenting to the investment community?
Right, well, there are two people who have strong views.
As a small cap investor, I don't want to dominate the answers, but I mean, the main thing is come and talk to us about your assets, talk about cash. We're really interested in the folding stuff. We're happy to write checks, but boy, do we need to see a cash payback. We're not interested in these kind of complicated long-term sort of paybacks of 5 and 10 years. Cash in for cash out.
Nick, you were saying that actually you like to find a company presenting a USP as opposed to just three splendid fellows who can build an oil company.
Yeah, I think that's true, and I think increasingly important that what really delights me is when a company, and this is how I invest across the sort of the large cap to small cap spectrum, is when company management comes in and tells me that they're really passionate about doing something that they're really good at, that other people aren't good at. That's just really exciting. I can really see how your business model works financially. I can understand it. I can see what the real economics of your business are, and I can understand why you're better at doing this than other people are, and that you're really focused on doing just what you're really good at. Because it's so common that people come in and they don't really explain that to us very clearly. That's what delights me is when a company comes in and just tells it to me really straight. That's what I want to encourage lots of people to do, is come in and tell us what your business is all about.
Yeah, all I'd say is that given that we've seen a number of raises from small and mid-cap oil companies this year so far, with the right project, the right prospects, funding for the oil and gas sector is very much open for business.
Right. Ladies and gentlemen, thank you for your attention. Could I also thank my panel for, I think, having a good go on your behalf. I could actually, we didn't talk about gas, all sorts of things we didn't talk about. But anyway, we'll be here next year. Take care. Thank you very much.
Thanks again to our panelists, everyone.